What is the average property tax rate in each state? If you are curious about how property tax rates vary across the United States, you are in the right place. Understanding these rates is essential for anyone interested in real estate investing. Property taxes are calculated as a percentage of a property's assessed value, and they can significantly impact your cash flow and overall returns. The average effective property tax rate in the United States is around 0.9% of a home's value. However, this average hides a wide range of rates from state to state. Effective tax rates reflected what homeowners actually pay, factoring in local assessment practices and exemptions. For example, New Jersey has one of the highest average property tax rates at approximately 2.33%. Following closely is Illinois with about 2.08% and Connecticut at around 1.79%. These higher rates can greatly reduce net rental income for investors. On the flip side, Hawaii boasts the lowest average property tax rate at 0.27%. Alabama follows with 0.39%, while Colorado has 0.49%. Nevada and South Carolina are also on the lower end, with rates of 0.50% and 0.53%, respectively. Lower property taxes in these states can improve cash flow, making properties more appealing to investors. Here's a quick look at some average effective property tax rates by state. New Jersey is at about 2.33%, Illinois at 2.08%, and Connecticut at 1.79%. New Hampshire is around 1.93%, and Texas has an average of 1.36%. New York is at 1.26%, while Wisconsin is at 1.25%. Pennsylvania sits at 1.19%, and Michigan at 1.15%. Rhode Island has 1.05%. These rates can vary within states due to local government policies and the needs of school districts. For instance, Texas does not have a state income tax, so it relies more heavily on property taxes. This results in a higher-than-average rate. Conversely, states like Hawaii and Alabama utilize other revenue sources, allowing them to maintain lower property taxes. From an investing perspective, property tax rates are just one aspect to consider. Investors should also look into how local governments assess property values and what exemptions may be available. Some areas offer tax incentives for specific types of properties, which can further influence the tax burden. Practical steps for investors include comparing property tax rates when evaluating different markets. It is also wise to factor property taxes into financial models to estimate net operating income. Researching local assessment practices is key, as some areas assess properties at full market value while others use a fraction of that value. Additionally, investigating whether tax abatements or homestead exemptions are available can help reduce the tax burden on investment properties. While lower property tax rates can make a market more attractive, it is essential to balance this with other factors like rental demand and property prices. High property tax rates may be offset by strong rental markets or property appreciation, while lower rates might come with slower growth or higher costs elsewhere. Property tax rates vary significantly by state, and they directly impact the economics of real estate investments. Savvy investors should research these rates as part of their due diligence, using them to compare markets and forecast expenses. Always verify local rates and rules, as they can change and may differ even within the same state.